Hi, welcome back. To this, the third session that we're doing on growth investing. In this session, I want to focus on screening for cheap growth stocks. If you remember in value investing, we talked about screening for value stocks, low PE ratios, low price to book. We're going to turn that process on its head here and bring what Ben Graham brought to value stocks into the growth stock domain. In fact, you could argue that this is essentially the Peter Lynch contribution to investing, because he brought in the rigor of value investing into growth investing, growth at a reasonable price, or GARP. So let's set the process up as to what kinds of screens might give you growth stocks that are cheap. You could screen just for high growth, and as we'll see very quickly and dismiss very quickly, buying stocks with high growth, high earnings growth, has never been a winner. You have to bring the pricing in, and there are two variants you might look for. One is just looking at a combination of low P ratios and high growth, or to bring them together into one equation. You divide the price earnings ratio by the growth rate to come up with what's called a PEG ratio. PEG ratio, very simply, is the PE ratio divided by the expected growth rate. So as an example, if you have a stock with a PE ratio of 20 and a growth rate of 10%, 20 divided by 10 is 2. The lower the PEG ratio, the cheaper the company. In effect, you're looking for a mismatch, a stock that trades at a low multiple of earnings and a high growth rate. Now, you can adapt this to enterprise value multiples, where you look at enterprise value to EBIT and high growth in operating income. But essentially, you're looking for a combination of high growth and low pricing. So let's look at the different screens, and let's start with the most simplistic screen. You're a growth investor. What excites you the most? High growth, right? Especially in earnings. Now, before we get too carried away, though, remember that there are two ways you can look at earnings growth. One is look backwards, historical growth, and estimate of past growth. And keep in mind the caveat that growth can be volatile. Starting points and ending points can matter. So you can very quickly make your growth look high or low by picking a starting period that was a really good one or a really bad one. There's some mean reversion in earnings growth, and you assume that, over time that earnings growth is going to move towards the average. And in many ways, revenue growth is more predictable than earnings growth. So historical growth, you can focus on past growth, use earnings growth, and if you don't trust earnings growth, look at revenue growth. But investing is all about the future, right? You want to invest based on expected future growth. So you want to pick stocks with high expected growth rates, and that comes with a catch. You could try to estimate the expected growth rate for every company, but that's going to be tough to do if you're looking at hundreds or even thousands of companies. But there's a fallback that people use. Analysts project growth for companies. Maybe you can pick companies that analysts are projecting high expected earnings growth for the company. Neither strategy has worked very well in the past. Past growth doesn't work very well because it turns out that the correlation, you'll see this in the next page, between past growth and future growth is pretty low. And in many ways, though, the point you might be missing when you pick high growth companies, even if the growth is right, is what if the pricing already reflects that high growth? You're getting a great growth company, but you're paying 50, 100, 150 times earnings, you might not be able to make money. Speaking of that correlation, in this graph, I've looked at the correlation between growth in one 5-year period and the growth in the next 5-year period. It's a little dated, 90 to 94 growth to 95 to 99. And you can see the correlation is very low at small cap firms, higher at large cap firms. I also looked at 2-year historical growth as a predictor of 2-year forward growth. Again, lower at smaller firms, higher at larger firms. And 1-year growth, last year's growth and next year's growth, lower at smaller firms, higher at larger firms. Put simply, the kinds of firms where you're most uncertain about future growth, small companies, historical growth is not a good predictor of future growth. So that screen of just screening for companies that have high expected growth without looking at the pricing is almost certainly not going to work. So you need to bring pricing into the mix. And there are two ways you can bring pricing into the mix. One is you can just do a very simplistic comparison of the price earnings ratio to the growth rate, and only buy stocks that trade at a PE ratio less than the growth rate. That sounds like a made-up strategy, but it's a strategy that some growth managers have adopted with some success over the last few decades. So as an example, let's say you have two stocks. One trades at 20 times earnings and the other trades at 10 times earnings. By itself, the 10 times earnings stock looks cheaper than the 20 times earnings stock, right? But let's assume the company that trades at 10 times earnings has a growth rate of 5%, and the company that trades at 20 times earnings has a growth rate of 25%. With this strategy, you'd buy the second stock because it has a PE ratio less than the growth rate. The advantage of this strategy, it's extremely simple. There's no need to compute ratios. But as we will see, it has its own weaknesses that come with it. The second strategy is to do what I suggested. Look at the PEG ratio, price earnings divided by the growth rate, and to try to pick stocks with low PEG ratios. A Morgan Stanley study from decades ago seemed to suggest that buying low PEG ratio stocks earned higher returns than buying high PEG ratio stocks. So let's take a deeper look at both of these strategies. Let's say you adopt a strategy of just buying stocks when the PE ratio is less than the growth rate. Here's the first problem. In periods when interest rates are high, everything is going to look cheap to you. 1979, 90% of US stocks traded a PE ratio less than the growth rate, but interest rates were 10, 12%. In 2018, 2019, 2020, less than 10% of US stocks trade less than the expected growth rate. But rather than think of this as a sign of undervalued versus overvalued stocks, it's a fact that when interest rates go up, PE ratios for all stocks decrease. And if interest rates are high enough, everything's going to look cheap to you. That's the first problem. The second is when you just compare PE to the growth rate and you don't factor in risk, you can see the potential weakness, right? That high growth might come with immense amounts of risk. A stock that looks cheap because it's PE less than the growth rate might not be cheap after you factor in risk. Historically, as I said, people have used this strategy. It's a simple strategy, but the payoff to it has become lower and lower, perhaps negative now, because it's so simplistic. What about PEG ratios? Again, in this graph, I've looked at just pure raw returns based on PEG ratio classes. And the lowest PEG ratio companies have earned significantly higher returns, and this is over 3 time periods, than stocks with the highest PEG ratios. Now you're saying, this is good. I'll just go buy low PEG ratio stocks. Remember, these are raw returns. I haven't adjusted for risk. And as I said, risk might be the wild card here. The lowest PEG ratio stocks might be earning higher returns, but after adjusting for risk, who knows? So let's take risk as the wild card and see how it plays out in the PEG ratio. I've taken a hypothetical company here with 2 different potential growth rates, 10% and 20%, and computed what the PEG ratio will be for stocks with betas ranging from 0.5, half as risky as the average stock, to beta 1.5, 1.5 times as risky. Notice with both growth rates, expected growth rates, the PEG ratio decreases as risk increases. So the stock with a beta 1.5 trades at a PEG ratio close to 1. Stock with a beta of 0.5 trades at a PEG ratio of 2.7. One is not cheaper than the other, they just reflect risk. The same thing applies with a higher growth rate. As you look across stocks, you should expect to see, if you pick stocks based on low PEG ratios, your portfolio has a lot of very risky stocks in it that look cheap but are not really cheap. In fact, to kind of establish this even more precisely, I broke stocks based on betas in 2025 into 5 classes, from lowest betas to highest betas, and computed the PEG ratios for stocks within each class. It's a period where markets overall have gone up, so the PEG ratios have all risen as well. The lowest risk stocks had a PEG ratio of 2.85. The highest PEG ratio stocks, the highest risk stocks had a PEG ratio of 2.01. Riskier stocks will look cheaper on a PEG ratio basis. There's one more point about PEG ratios that I want to bring home. When you talk about PE ratios and growth, we know the relationship. As growth goes up, holding all else constant, PE ratio should go up. So we can control for difference in growth. A high PE ratio versus a low PE ratio, you'll say, I'm going to control for growth. When you get to PEG ratios, the relationship with growth gets messy. What I mean by that is initially as you increase growth in a company, these are with hypothetical companies, the PEG ratio decreases. But there's a point where as the growth goes up, the PEG ratio starts to go up. You're saying, so what? Let's say I give you 10 companies and I give you the PEG ratios for all 10 companies and the growth rates for all 10. You're going to try to control for growth, right? If growth has a relationship that's always in one direction, as was the case with PE and growth, controlling it becomes easier. Higher growth companies should trade at higher PE. With PEG ratios, that control becomes much more difficult to impose. I'll be honest with you, I do not like PEG ratios as a multiple. They have properties that make them difficult to work with and can lead you down the wrong path. But if you do decide to go with PEG ratios, factor in the reality that just because you've used a PEG ratio doesn't mean growth has gone away, that it's been factored in already, or that risk has been dealt with. Both have to be brought into the process. But overall, if you decide that you're going to adopt a screening approach to find cheap stocks for you, here are the three things that will determine whether you can be successful. You have to be better at assessing future growth than most other people are. If all you're doing is getting growth rates that analysts are projecting for companies and plugging them in, odds are your chances of success have dropped off. If you can come up with more finessed estimates of growth that are better than the analyst estimates or better than historical growth rates, you have a better chance of success. It might sound like a broken record here, but the longer your time horizon, the greater your chance of succeeding with a passive growth strategy where you're screening for growth companies. And there's a component of market timing here. Think of why. As with IPOs, with growth stocks, what you tend to find is when stocks are doing exceptionally well, growth screens, there are periods where growth screens work better. And if you can time these market cycles where growth screens work better, you might be able to earn a higher return as well. There's a market timing component to growth investing that might not be a factor when you did value screening. So in summary, can you screen for cheap growth stocks? Yes. PEG ratios, PE less than growth. Those screens have a history of working on paper, but the key is to control for the factors that might be explaining why the PEG ratios vary across time, risk and growth, that have to be brought into the story. I hope you found this session useful, and I thank you very much for listening.